everyone, and welcome. Get ready because today I am absolutely stepping in as your personal exam coach. We're going to decode the ACCA financial reporting syllabus together in this explainer. Now, we are looking at a very specific, highly tested theme today, the accounting timeline. We're going to master IAS 7, IAS 8, and IAS 10, and we're bringing these seemingly dry standards to life by figuring out exactly where they fit on our timeline. So, are you ready to lock in those ACCA FR marks? I know you are. Okay, let's dive right into this. This explainer is all about high-yield, exam-focused revision. We aren't just, memorizing definitions here. We're looking at the exact mechanical fixes that will save you from those classic pitfalls the examiner literally loves to set up. By the end of this, you'll know exactly how to secure those crucial marks. All right, here's our roadmap for today. First up, tracking cash with IAS 7. Second, time travel with IAS 8. Third, the twilight zone with IAS 10. And finally, we'll wrap up with exam traps. Let's jump into Section 1, tracking cash, the cash flow reality. The crucial reality we really have to face is that profit, it's mostly just an accounting concept. Thanks to accruals and matching, your income statement might show this massive, beautiful profit, but if the bank account is completely empty, the business is in deep trouble. So you look at a healthy profit and you have to ask yourself, where did the cash actually go? It's a provocative question for sure, but we absolutely have to look beyond the income statement to understand the real liquidity and viability of a company. And that brings us to the formal definition of IAS 7. This standard basically requires us to reconcile that paper accounting profit to the actual physical cash movements. It's brilliantly structured around categorizing those cash movements into three very distinct buckets, making sure every single dollar in and out is accounted for. Those three buckets are operating activities, which is just cash from everyday trading, investing activities, like buying or selling non-current assets, and financing activities, which covers things like issuing shares, taking out loans, or paying dividends. Literally every cash movement falls into one of these three steps. Okay, now the sequence for the indirect method of calculating operating cash flow is exactly what you need to memorize for your exam workings. It's a real game changer. You always start with profit before tax. Then you adjust for non-cash items, so you add back depreciation and adjust for gains or losses on disposal, plus any movements in provisions. Then comes the tricky part. Working capital. If receivables increase, it means your cash is tied up with customers, so you subtract it. If payables increase, you're holding on to your cash longer, so you add it. If inventory increases, you spent cash to buy it, so you subtract. Seriously, master this specific sequence, and you master IAS 7. So the absolutely crucial point here is captured in our one-line summary. Cash flow equals operating plus investing plus financing. Adjust profit for non-cash and working capital. Say it out loud to yourself. Write it down on a sticky note. This needs to be your mental trigger the second you sit down for the exam. Moving right along to Section 2, time travel, policies, estimates, and errors. So while accounting usually just marches forward, sometimes we kind of have to figure out how to deal with changing the rules of the past or estimating the uncertainties of the future. IAS 8 dictates exactly when we are allowed to touch prior year figures versus when we just adjust things moving forward. It deals with three distinct things: accounting policies, accounting estimates, and prior period errors. And let me tell you, knowing the difference between these three is exactly where the exam marks live. This really illustrates the core battle of IAS 8, retrospective application versus prospective application. Basically, policies and errors look backward. That's retrospective. Estimates look forward. That's prospective. Let's break down the exact mechanical difference here so you don't drop any easy marks. Retrospective application means you have to go back and adjust opening retained earnings and restate the comparative figures from the prior year. You are essentially rewriting history as if the new policy or the correct figure was just always there. Prospective application, much easier. You basically draw a line in the sand, you apply the change only from the date of change forward. No restatement required whatsoever. For example, changing a depreciation method from 10 years to 5 years is just a change in estimate. You apply it right now, prospectively, and move on. Here is your one-line trigger phrase to lock IAS 8 into your brain forever. Policy equals restate, estimate equals prospective, error equals restate. If you can remember this simple formula, you are going to navigate any IAS 8 scenario the examiner throws at you. Section 3, the twilight zone, after the reporting date. Welcome to the twilight zone. This is that mysterious period right after your year-end date, but before the financial statements are actually published and sent out into the wild. The formal definition of IAS 10 outlines this critical window. We are looking at events occurring specifically between the reporting date, let's say December 31st, and the date the financial statements are formally authorized for issue by the board, which might be all the way in March. The examiner absolutely loves to test what you do with new information that comes to light during this specific time frame. Honestly, everything in this standard boils down to this one comparison. Is it an adjusting event or a non-adjusting event? To figure it out, just ask yourself one question. Did the condition exist at the stroke of midnight on the reporting date? If the evidence points to a condition that existed at year-end, it's adjusting, and you physically change the financial statements. But if it's a completely new condition that arose after the year-end, well, it's not adjusting. You just disclose it in the notes and call it a day. Let's speed through a few classic examiner examples. A customer goes bankrupt after year-end. That is usually adjusting, because it proves they were already in bad financial shape at year-end. Settlement of a court case, adjusting. But what about a fire loss after year-end? Non-adjusting, because the building was perfectly fine on December 31st. A major acquisition or a sudden change in tax rates, also non-adjusting. And please pay very close attention to this last one. Dividends declared after year-end. This is a massive trap. It is non-adjusting. Do not recognize a liability for them at year-end. You only disclose them. Let's hammer home our third one-line summary to completely secure your understanding of the twilight zone. IAS 10 equals adjusting, which means it's an existing condition, so you adjust. Non-adjusting means it's a new condition, so you disclose. Keep it exactly that simple. Finally, Section 4, Exam Traps, Securing Your Marks. All right, we are moving into the final stretch here, and the stakes are high. We are focusing purely on what goes wrong in the actual exam room. Please, whatever you do, don't lose easy marks. Let's lock down the examiner's favorite tricks right now so you can walk in and pass with absolute confidence. Let's walk through these methodical fixes. First, the IAS 7 trap. Getting working capital changes backwards. It happens all the time. The fix? Always remember that an increase in receivables is a cash outflow, so you have to subtract it. Think of it like you've essentially loaned the customer money. Second, the IAS 8 trap. Treating a change in an accounting estimate like it's an error. The fix here? Just remember that changing an estimate, like a machine's useful life, is prospective. Do not restate opening balances. And finally, the IAS 10 trap we literally just talked about, adjusting for new dividends. The fix? Dividends declared after the year-end are disclosed only. Never, ever put them in the statement of financial position as a liability. So I'll leave you with this final thought. Have you mastered the accounting timeline? Look at how interconnected all these rules are. Cash flow tells us the real story today. IAS 8 cleans up our past and sets our future estimates. And IAS 10 handles that weird twilight zone right after year-end. If you apply these rules and avoid those classic traps, you will absolutely crush these topics. I hope this explainer has left you feeling confident and hungry to tackle the rest of the syllabus. Keep practicing, you've got this, and I'll see you in the next one.